3 times in the last 40 years, a specific sequence of signals appeared in the financial data. Not a rumor, not a feeling, a pattern. 12 months after that pattern triggered, the markets broke, not corrected, not dipped, broke. And right now, in the current data, in the numbers that most analysts aren't talking about, that pattern just appeared again. Your portfolio doesn't know it yet. Your bank probably does. This is the Capital Codex. And today, we go inside the one sequence that has predicted every major financial collapse of the modern era. Before that, professionals admitted it was coming. To understand what's happening right now, you need to understand what the world looks like just before everything goes wrong. It doesn't look like chaos. It looks like this. Confidence is high. Credit is flowing. The headlines are good. The jobs numbers are solid. And somewhere, in a glass and steel office building, a senior risk manager is telling his board, "We've stress tested for this. We're fine." This is the phase economists call the Great Moderation. The period right before the break, when the system isn't just stable, it's suspiciously stable. Here's the thing about financial systems. They don't collapse because of one bad decision. They collapse because of 10,000 good decisions made inside a flawed framework, all compounding quietly for years. The flaws don't announce themselves. They hide inside the strengths. So what is the pattern? It has a name inside quantitative finance circles. They call it the pre-collapse sequence. It's not a single indicator. It's a convergence. 4 specific signals appearing within the same 18-month window. Each one, individually, is explainable, manageable. Each one has been explained away by the smartest people in every room, in every cycle. But when all 4 appear together, every single time, the system breaks. In 2006, 93% of institutional fund managers surveyed said a housing crash was unlikely or impossible. The market peaked 4 months later. Signal 1 is the one you've probably heard of, even if you don't know its name. The yield curve inversion. This is when short-term government bonds pay more interest than long-term bonds. Under normal conditions, that's backwards. Lending money for 30 years should pay more than lending it for 2. The risk is higher. The time is longer. When that relationship flips, when the 2-year treasury yields more than the 10-year, it means something has gone deeply wrong in how the market prices the future. The yield curve inverted before the 1990 recession, before the dot-com crash, before 2008, and in the spring of 2023, it inverted to its deepest level in 40 years. But, and this is critical, the inversion alone isn't the trigger. Here's what every financial media outlet gets wrong. They report the inversion. They say, recession incoming. People panic for 6 months. Nothing happens. The pundits look foolish. The market climbs another 15%. Everyone relaxes. That relaxation is the trap. Because signal 1, the inversion, is not the gun going off. It's the loading of the weapon. The crash doesn't come when the curve inverts. It comes when the curve re-steepens. When the short end drops back down, when the Federal Reserve starts cutting rates in response to a weakening economy, that is when the historical clock starts. And in late 2024, the Fed began cutting. The clock is running. And signals 2, 3, and 4, the ones nobody's talking about, they just came online. 4 signals. You already know signal 1, the yield curve inversion and its re-steepening. Now we go deeper. Because the pattern doesn't become dangerous with one signal. It becomes lethal when the other 3 lock into place around it, like tumblers in a vault, clicking one by one into alignment. And history shows us exactly how that sequence unfolds, not as theory, as documented fact. Let's go back to 2006. The first crack appeared in the language, not the data, the language. In 2006, the word contained began appearing in official financial communications with unusual frequency. Federal Reserve meeting minutes, Treasury briefings, bank earnings calls. The situation is contained. Subprime exposure is contained. Any spillover risk remains contained. When institutions start using the same word, unprompted, repeatedly, in different rooms, it means one thing. They are all looking at the same thing, and they are all scared. This is signal 2, the confidence language collapse. It's not measured in basis points or balance sheets. It's measured in what powerful people say when they're trying not to cause a panic. Watch for the euphemisms. Watch for the passive voice. Watch for the phrases that take a sharp fact and wrap it in soft cotton. Temporary headwinds, transitional pressures, orderly adjustment. Right now, in 2025 and into 2026, that language is back. Listen to any central bank press conference from the last 8 months. Count the word resilient, resilient economy, resilient labor market, resilient consumer. Say something is resilient enough times, and you're not describing strength. You're describing hope. In the 14 months before Lehman Brothers collapsed, its CEO used the word strong to describe the firm's balance sheet on 23 separate public occasions. The firm had $613 billion in debt. Signal 3. This one lives in the credit markets, and it's the one that institutional traders watch more closely than almost anything else. It's called the credit spread compression paradox. Here's how it works. In a healthy, functioning market, risky borrowers pay more to borrow money than safe borrowers. That's the spread, the gap in interest rates between a rated government bond and a junk-rated corporate bond. When that spread is wide, it means the market is nervous. Risk is being priced properly. When that spread compresses, when junk bonds start trading almost as cheaply as safe bonds, it means one of two things. Either the world has genuinely become safer, or investors have become so hungry for yield that they've stopped caring about risk. In late 2006, credit spreads compressed to near historic lows. In 2019, the last time this pattern fully assembled, they compressed again. In 2024, they hit their tightest levels since 2007. Nobody rang a bell. Nobody sent a warning. The machines kept buying. The bonuses kept coming. The spreads kept tightening. And the vault kept clicking. Signal 4 is the most personal one, because Signal 4 isn't about institutions. It isn't about spreads or yield curves or language patterns in Fed minutes. Signal 4 is about you. Specifically, it's about what retail investors, ordinary people, do with their money in the 18 months before a collapse. Economists have a clinical term for it. They call it retail capitulation into risk. Every single time the pattern has completed, 1987, 2000, 2007, 2019, the same thing happened in the retail data. Individual investors, who had been cautious for years, finally gave up waiting. They stopped holding cash. They moved into the exact assets that had been climbing the longest. They bought at the top, not because they were foolish, but because the evidence looked overwhelming. The market had been climbing for years. The professionals were in. The media was bullish. The only irrational thing, it seemed, was to stay out. In 2024, the American Association of Individual Investors reported that cash allocations among retail investors hit their lowest level since 2000. The year 2000. You know what happened next that time? Simultaneously, margin debt. The borrowed money that investors used to amplify their bets climbed back above $800 billion. Borrowed money, chasing a market at all-time highs. All 4 signals are now present. The yield curve re-steepened. The language shifted. The credit spreads compressed. And retail money flooded in. This is the window. This is the 12 to 18-month period that history shows us over and over and over again. Ends the same way. The only question that remains is the same question nobody in 2006 could answer. Nobody in 1999 could answer. What is the trigger? Because the pattern doesn't tell you what breaks the system. It only tells you that the system's ready to break. The trigger could be anything. A single bank, a single sovereign debt crisis, a single piece of jobs data that comes in wrong on a Tuesday morning. The powder is dry. Let's talk about how it actually happens. Because the movies get this wrong every time. The collapse doesn't look like an explosion. It doesn't look like a tsunami hitting a city. It looks like a phone call that nobody answers. September 15th, 2008, 1:45 in the morning. Lehman Brothers files for the largest bankruptcy in American history. $691 billion in assets. Gone. Legally. Overnight. The next morning, the global financial system woke up and realized it had no idea who owned what. Not because the assets disappeared. Because the counterparty risk, the web of who owed what to whom, had become so complex, so layered, so deliberately obscured through derivatives and structured products, that no institution on earth could calculate its own exposure. Here is the math of a modern financial collapse. It does not move at the speed of human decision-making. By the time Lehman filed, algorithmic trading systems had already begun executing pre-programmed sell orders. Margin calls were being issued automatically. Money market funds, the instruments that millions of Americans believed were essentially cash, began breaking the buck. Their value fell below $1. The reserve primary fund, $62 billion in assets. Considered one of the safest instruments in the American financial system. It broke in 24 hours. And here's what no textbook prepares you for. The freeze. Before the panic, there's a freeze. A 48 to 72 hour window where the system doesn't crash violently. It just stops. Interbank lending, the overnight loans that banks make to each other to manage their daily cash flow, dried up in 72 hours. Completely. Banks stopped trusting each other. Not because they knew which banks were insolvent, because they didn't know which ones weren't. The government response was not a rescue. It was a controlled detonation. TARP, $700 billion. Authorized in 10 days. The Fed's balance sheet, $900 billion before the crisis, ballooned to $2.2 trillion by the end of 2008. By 2014, it hit $4.5 trillion. The fire was put out, but the water damage, the moral hazard, the debt load, the institutional dependency on cheap money that soaked into the foundation of the global financial system. And it never fully dried. Here is the number that never makes the headlines. The total estimated cost of the 2008 financial crisis to the American economy in lost output, lost wealth, lost wages, lost retirement savings is estimated by the Dallas Federal Reserve at $14 trillion. Not $700 billion, not the bailout number. $14 trillion. That's nearly an entire year of American GDP. Evaporated because 4 signals aligned, and nobody acted on them in time. The 5 largest bank bailouts in U.S. history all occurred after regulators publicly stated the banking system was well capitalized and sound. The 2008 collapse wasn't a black swan. A black swan is an event nobody could have predicted. 2008 was a beige swan. It was visible. It was documented. Multiple economists, Nouriel Roubini, Raghuram Rajan, Michael Burry, warned about it specifically, publicly, with data. They were dismissed. Not because the warnings were wrong, because the warnings were inconvenient. Because the incentive structure of the entire financial system, from the mortgage broker to the ratings agency to the investment bank to the regulator, was built to reward the continuation of the cycle, not its interruption. The system reset for a time. But the pattern, it didn't reset. It reloaded. Every financial collapse in recorded modern history follows the same 5-stage sequence. Not similar, not comparable. The same. The names change, the assets change, the geography changes, the century changes, The sequence does not. We call it the codex pattern. And once you see it, truly see it, you cannot watch a financial news broadcast the same way again. Stage 1. Complacency. This is the stage that always looks, in retrospect, like collective madness. But it never feels like madness when you're inside it. It feels like evidence. The economy has been growing for years. Asset prices have been climbing. The models say the risk is low. The data confirms the models. The models confirm the data. This is the stage where the phrase, "it's different this time," gets spoken, not by fools, but by the most credentialed, most respected, most data-saturated analysts in the world. Irving Fisher, one of the greatest economists America ever produced, stood before a room of professionals in October 1929 and announced that stock prices had reached a permanently high plateau. 3 days later, the market began its 89% collapse. Stage 2. Excess. Complacency creates permission. Permission creates excess. This is the stage where the original legitimate investment thesis. Real estate is a reliable store of value. Technology is transforming the economy. Emerging markets are the next growth engine. It's weaponized. The thesis was never wrong. The underlying reality was real. But excess doesn't require a false premise. It requires a true premise, overextended past the point of reason. Tulip bulbs had genuine horticultural value in 1637 Amsterdam. Dot-com companies genuinely were transforming commerce in 1999. American housing genuinely had been a reliable investment for 60 years before 2006. The excess wasn't the idea. The excess was the leverage, the scale, the certainty. The moment a market stops asking, "Is this a good investment?" and starts asking, "How much can I borrow to do more of it?" Stage 2 has arrived. In 1637, a single tulip bulb sold for 10 times the annual salary of a skilled Dutch craftsman. The market collapsed within weeks. The Dutch called it wind handle, trading in wind. Stage 3. Warning. The pattern doesn't move invisibly from excess to panic. There is always a warning stage. Always. The tragedy of financial history isn't that the warnings didn't exist. It's that the warnings were heard, evaluated, and dismissed by intelligent people with sophisticated tools, operating under enormous institutional pressure to keep the machine running. The warning stage has a signature. It sounds like this. Yes, there are concerns. But the fundamentals remain strong. Yes, there are isolated pockets of stress. But the broader system is healthy. Yes, some analysts are cautious. But the data doesn't support alarmism. Hear those phrases? In any combination, from any official source, about any asset class? You are inside stage 3. Stage 4. Panic. You've seen the data. You know what panic looks like in the numbers. But here's what the data doesn't capture. Panic, in real time, is not loud. It's quiet. It's a phone that stops ringing. A bid that doesn't come. A redemption request that takes 3 days to process instead of 1. A counterparty that asks for more collateral, not dramatically, not with alarm, just quietly asks. And then asks again the next morning. The noise comes later. The screaming ticker tapes and the breaking news chirons. That's the announcement of a panic that already happened in silence. In spreadsheets, in back-channel calls between risk managers at 2 in the morning. By the time you see it on television, the panic is already over. What you're watching is the autopsy. Stage 5. Reset. This is the stage that gets misread most consistently. The reset is not recovery. Recovery is when you return to where you were. The reset is something different. It's a recalibration of what normal means at a new, lower baseline, built on a new set of assumptions, held together by a new set of rules. After 1929, the Glass-Steagall Act, deposit insurance. The SEC, after 2008 Dodd-Frank, Basel III, stress tests. Every reset produces new guardrails. Every new guardrail creates a new constraint. Every new constraint creates a new pressure point. Every new pressure point, given enough time, enough complacency, enough excess, becomes the next crack. The pattern doesn't repeat because humanity is stupid. It repeats because the people who lived through the last collapse age out of the system, and the people who only read about it take their seats. And the reading is never quite the same as the living. So where are we today? Not historically, not theoretically. Right now, March 2026, 3 parallels, 3 pressure points, 3 places where the codex pattern is live and active. Watch carefully. Parallel 1, private credit, the $1.7 trillion shadow. Since 2008, regulatory pressure pushed riskier lending out of traditional banks. The banks got cleaner, on paper. But the lending didn't stop. It moved into private credit markets, business development companies, non-bank lenders operating almost entirely outside the regulatory perimeter that Dodd-Frank built. Private credit has grown from roughly $400 billion in 2010 to an estimated $1.7 trillion today. This is not inherently dangerous. Private credit serves a genuine function. What is dangerous? Most of these instruments have never been tested in a real credit contraction. The managers running these funds were hired during the longest credit expansion in modern history. Their models have never seen a genuine default cycle. Sound familiar? The 2008 CDO managers had never seen a national housing price decline either. Parallel 2, commercial real estate. The slow bleed. Office vacancy rates in major American cities sit at or near historic highs. In San Francisco, above 30%. In Chicago, Dallas, Houston, climbing. This isn't news. You've heard about the work from home problem. What you haven't heard, or haven't heard framed correctly, is the bank exposure problem. Regional and community banks hold an estimated 70% of all outstanding commercial real estate loans in the United States. These are not the too big to fail institutions with federal backstops and robust stress testing infrastructure. These are the banks that lend to small businesses, that hold your local deposits, that underpin the credit access of entire regional economies. As commercial real estate loans mature and require refinancing at interest rates that are substantially higher than when those loans were originated, the math stops working. Not all at once, slowly, loan by loan, quarter by quarter. The first domino has already fallen. You watched it happen in 2023 with Silicon Valley Bank, with Signature, with First Republic. 3 banks, $500 billion in combined assets, gone in a single quarter. The FDIC called it isolated stress. The pattern calls it stage 3, parallel 3, the AI capital expenditure supercycle. And the question nobody's asking. This one requires intellectual honesty. AI is real. The technology is transformative. The productivity gains are genuine and documented. This is not 1999. The companies spending $300 billion annually on AI infrastructure are not building websites for pets. But there is a number that should stop you cold. The hyperscalers Microsoft, Google, Amazon, Meta have collectively committed to over $300 billion in AI capital expenditure in 2025 alone. This figure is expected to compound. The question every analyst is asking: will the revenue justify the investment? The question nobody is asking loudly enough: what happens to the companies and their lenders if the revenue timeline is 3 years later than the model's project? Technology investment cycles have a consistent historical feature. The infrastructure gets built before the monetization arrives. The gap between the two is where capital goes to die. The railroad boom of the 1840s transformed America. It also produced the largest debt default in American history up to that point. The optical fiber build-out of the late 1990s created the backbone of the modern internet. It also bankrupted WorldCom, Global Crossing, and dozens of others. The infrastructure was not a mistake. The leverage used to build it, on a timeline that assumed immediate returns, was 3 parallels. 3 open questions. 3 places where the codex pattern is active right now. Not predictions, not certainties, patterns. And patterns, by definition, are only visible to those who know what to look for. Now you know. Here is the question that should keep you up tonight. In every collapse in this script, 1929, 1987, 2008, historians identified the trigger after the fact. The thing that, when it broke everything else. For 2008, it was Lehman. For 1997, it was the Thai baht. For 1987, it was portfolio insurance, an algorithm designed to prevent crashes that caused one instead. The 4 signals tell you the system is loaded. They do not tell you what pulls the trigger. So here's the question no one in finance is willing to answer on the record. In a world where AI systems now execute 70% of all equity trades, what happens when the trigger is not a bank, not a currency, not a policy decision, but an algorithm? The first AI-driven flash crash already happened. Most people called it a glitch. The pattern has a different word for it, a rehearsal. The next video in this series examines the 2010 flash crash, when $1 trillion vanished from markets in 36 minutes, and the algorithm responsible was never fully identified.